What's up, guys? It's Moneybags here. Today we're going to be talking about PDT rules and how to avoid them. This is honestly one of the most asked questions I get because I do a lot of small account challenges and people are constantly wondering how I get away with placing 10 trades a day from a small account while day trading. The answer is I'm Canadian, so I can do that. We don't have PDT rules here, but majority of the followers that we have are actually from the UK and the US, so you guys do have PDT rules in some areas of the UK and all over the US. So we're going to be figuring out ways you can get around this. And as a brief disclosure, this is for informational purposes only. I'm not telling you to avoid PDT rules. We're going to be talking about why they're there and what they do, so you can make an educated decision on what works best for you. So today we're going to be covering what PDT rules are, why they're there, and how we can avoid them if we need to. So what is PDT? It's called the Pattern Day Trader Rule. These rules flag your account if you do more than 3 day trades a week. After you've been flagged twice, I believe, they freeze your account for 90 days and you can't trade anything. This is a huge problem for day traders as we do a ton of trading and we don't want frozen accounts. So why do they even bother with PDT rule? Well, to put it bluntly, retail traders used to be highly uneducated with trading and they have absolutely no risk management. And this leads you to blowing up your account and possibly even using the margin of your brokerage and not being able to pay it back. So they had a huge issue with bankruptcy from retail day trading. A long story short, it's actually there to protect you. So how can we avoid PDT rules if we choose to do so? Well, there's quite a few ways. People have been finding ways around this for quite some time. First off, you can have a cash account. You can have an offshore account. You can apply for a trading firm. You can fund your regular account with 25K in cash or assets, or you can have multiple brokerage accounts. And we'll dive into each of these a little bit. So cash accounts. You can place however many day trades you want as long as you have the cash for it. However, settlement of the cash you usually use will take 1 to 2 days. This means money that you used on Monday to trade won't be available till Wednesday for more trading. This is the simplest way around PDT rules, but the least effective as it really limits your profitability, and it also is my second least option. So this is the second to last option I would ever want somebody to choose. And it does kind of work, but the main issue is, if you've got $1,000 and you're placing 5 trades a day, you want to spread those trades out to make sure that from Monday to Wednesday you can make trades every day. You're looking at only placing like $50 trades on each trade, and if you're only making a couple percent each time, that really, really limits what you can do. With a margin account, you get instant settlement. So if I have $1,000 account on a margin account, I can throw that $1,000 into a trade, take it out, throw it into the next trade, take it out, throw it into the next one, and so on. So that's why this is so limiting. So the next one is offshore accounts. Offshore accounts are just brokerages not located in the US, which means they don't follow the rules of FINRA, and therefore they do not enforce PDT rules. The major drawback is the fees that they charge. They know that they have an edge and they take advantage of it with a decent amount of fees. The next thing is filing taxes can be a bit more tricky, but we're not really going to cover that here. And it's also kind of a pain to set up the brokerage account offshore sometimes. However, this will let you trade like a regular account, and you can even have a high level of leverage, which can be both a good and bad thing. So you could leverage a trade, I think CMEG offers a 6x leverage, which can be really good if you're profitable and really, really bad if you're not. So be careful with that. So the next one is trading firms. Trading firms will literally give you a funded account to day trade with. However, they're going to take a percentage of the profits, and they usually make you take evaluations and tests and make you jump through hoops to trade for them. So if you're new to day trading, I would suggest not going this route, as it usually costs money to take their evaluations, and if you don't know what you're doing, there's probably no chance you're going to pass unless you get lucky. So also as mentioned, you can fund an account with 25K, and this lets you use your familiar brokerage account and day trade as much as you want. The one main drawback to this is not everyone has 25K to throw into an account. And with that being said, you're also living in a constant anxiety or anxious state of having to maintain that 25K, because if you drop below 25K, you'll be flagged for PDT rules like almost immediately. So even having 25K really isn't enough. You need to actually have more than that. You need to have some sort of cushion there so that if you do make a couple bad trades and you go down a little bit, it's not going to drop you past that $25,000 mark. So last and certainly least, the worst option I've ever heard of is to have multiple brokerage accounts. Essentially, the idea is you open up a bunch of margin accounts and you day trade 3 times on each week. Man, where do I even start with this one? First, you need to be careful not to overtrade on any single account. Second, you have to see how many day trades. Have you seen how many day trades a regular trader makes? A regular day trader? They make an insane amount. I make usually anywhere from like 10 to 25 trades a day, but just to play it safe, we're going to say 5 trades a day. If you're doing 5 trades a day, that's 25 trades a week, which means you need how many accounts open and available to trade each week? Yeah, you do the math. You're already up there with the very, very basic bare minimum. So, I mean, realistically, you probably have 25 accounts open, and good luck filing taxes for that. So let's go back to the best option, in my opinion, offshore brokerages. They all have different APIs and different pros and cons. Some will let you open an account, and some will be picky based on where you live and where you're located. So you'll need to do some research. But once you get funded on an offshore account, you can day trade as much as you want. Some of the more popular ones I know are listed here. We've got TradeZero, Alliance Trader, CMC Markets, IG Trading, CMEG, eToro. And like I said, all have their pros, all have their cons. You need to see which ones allow you to open an account in your area, which ones have what sort of fees and leverage, and what they offer, and if they have any restrictions and all that kind of stuff. I'm not going to do all the homework for you, but there's lots of options out there. You just need to put in the time and effort to sit down and go through and figure it all out. And I got to say, if you want to day trade, this is a good first step. You're going to have to learn how to Google and do research because day trading is not easy. So, if you can't sit down and figure out how to open up an account like this, chances are day trading probably won't be for you anyway. So if you found this video helpful or want more tips and tricks with day trading, make sure you like and subscribe for more to come. Thanks, guys.